how you doing?
I'm doing great, Jeremy. How are you?
Fantastic, thank you. So here's another edition of Between Two Fiduciaries. Today we're going to be talking about innovation stocks. So the first thing we wanted to discuss is something that's been around for some time now, many decades in fact. It's called Moore's Law. And people have heard about this before, I'm quite sure. The gist of it is that the technical gist is that you have more transistors going onto microchips every year. In fact, what they're saying is that you double the number of transistors on a microchip every 2 years. And by doing that, you're speeding up computing, you're making things faster and better.
Faster, better, smaller. I mean, you think about the technology. I think one of the easiest ways that I look at this is thinking about the size of computers when Moore's law became a thing, and I think about the power of the phone that you hold in your hand on a daily basis, and thinking about how small that is, yet how powerful it is compared to what the machines looked like when Moore's law was a thing decades ago.
You can quite literally take this thing back to the 70s and see what was going on there in terms of the number of transistors on these microchips, the power of those microchips.
Right.
And you think about like going to the moon.
Yeah.
And now we have in our hands a computer every single day that is way more powerful than anything they had in the Apollo program.
That's exactly right.
It's pretty wild. So this has really allowed things to get bigger, faster, better, and cheaper as well.
Yeah.
And so that's been an interesting thing. And so this just speaks to the innovation of computing, the innovation of technology.
Right.
Now there's some out there that say there's going to be a finite end to Moore's law.
Right.
That's probably true. Nanotechnology can only go so far. Perhaps. That's what we know right now.
Unless there's some other new innovation that we're not even aware of today.
You never know. So this relates back to the stock market in so many different ways, but one of the things that we hear a lot about perhaps in the media is the Magnificent Seven. And no, we're not talking about the movie. We're talking about 7 different stocks. I'll name them off real quick. Apple, Microsoft, Amazon, Nvidia, Google, Tesla, and Meta or Facebook.
Right. So the acronym or the naming of these stocks has evolved and changed over years, but it used to be like the FANG stocks, right? And then we've had some name changes and some different additions to this, but the theory amongst the going back to Moore's law and these companies and the application of innovation is that all holds the same to be true for all those companies.
Exactly. And this is a year-to-date chart. We're making a comparison. There's the aggregate of these 7 stocks in green. In black, you have the S&P 500. So saying it flat out, this has been a really good year for the S&P 500.
Right, no question.
Period. And then you look at how these 7 stocks have performed, and they have just ripped and roared well above the benchmark.
Right, absolutely. I think it's important. So yes, these things have ripped and roared. Important to note that if we were to go back into 2022, a lot of these stocks, had very poor performance. So yes, they have ripped and roared here in 2023, but a number of the stocks in the Magnificent Seven, you think about using one like Meta, for example, was down substantially in 2022.
No doubt about it.
So the roaring returns that we're getting this year aren't necessarily for the faint of heart, because 2022 would have been a difficult year to hold all these through the difficult time in the market that we had last year.
Well said. One of the things that we know this year has been driving those Magnificent Seven stocks forward has been the AI, artificial intelligence, this opportunity that is out there. And it's been manifest through things like ChatGPT, where people can actually interface with it and see how powerful it is.
Right.
But I think, AI has been around. It's not brand new.
Right.
By any means, but it's certainly driven the narrative here in 2023.
Yeah, it seems like anytime any of these companies comes out with something that AI is in the press release or is in the details, that seems to be a real driving force for more positive market returns.
Exactly, and so what you're seeing here on the screen right now is from McKinsey, and they're looking at the different areas of innovation. AI happens to be one of them. What you're seeing as you look at the chart here, the darker the color, the more investment the larger the size, the more investment going on there. The darker the color, the more adoption taking place within that innovation. And then as you scale to the right on this, you're seeing more popularity, more interest.
Yep.
So the point of putting this up here is not to really talk about each and every one of them, but instead we want you to see that there's a lot of things going on within the innovation bunch. You're not just getting AI, you're getting things like, cloud computing in there. You're getting things like the electrification of a smart grid and renewables. There's a lot of different sectors.
There's a lot of smart people out there working very hard to continue to drive innovation and technology forward to create and build, in theory, a better world for us all.
Exactly. And so these companies, like the Magnificent Seven, like the tech stocks in general. So in the S&P 500, tech makes up just under 30% of the benchmark.
Yep.
You're getting a lot of interplay with these innovation areas. They've got a good runway probably for the long run, don't they?
Yeah, you'd certainly think so. I mean, what we don't know, I mean, the future is very hard to predict, right? But what we do know there are a lot of companies out there that have a lot of very bright people that are trying to take these technologies, building better products, driving future growth.
You don't know who's going to be the winners.
That's the big question, right?
You just don't. And you said it earlier, the name of the Magnificent Seven has changed. It used to be FANG. Well, now it's the Magnificent Seven. NVIDIA is in there. They've soared into sort of like the upper echelon in this group, and I don't think a lot of people saw that coming necessarily.
No, I would absolutely agree with that.
So that's just one example of how it can be a little random, but we do feel like it's really important to point out some of the positives and negatives, and that's what we're going to talk about next. Positives and pitfalls of innovation stocks. Jimmy, start out by telling me about the positives.
Yeah. So again, as we've seen this year, year to date, we showed there's been a lot of growth and capital appreciation in this Magnificent Seven. When you look at longer term and you zoom out a little bit, you're going to see that the same kind of holds true for the last decade. That these stocks have provided a good chunk of the gains in the broader market. So the impact of that is the long-term capital gains. If you've held these stocks for a longer period of time than just this year, and you've held them for let's say the last decade, well, you get much more favorable tax treatment on the gains in those stocks. So we know that long-term capital gains are stocks that are held for more than a year, and the rate that you pay on the tax of the gain there is lower than if you were just trading it for less than a year and having short-term capital gains.
You got it. Yep.
And then again, these companies, as we see with the different innovations that we were looking at on the previous slide there, these companies are reinvesting a lot of their profits and putting it back into research and development to continue to push things forward and continue to try to innovate and create better products for us all.
They really do that as well. And this is not me just a hype machine for technology companies, but they really have to put a lot of money back into the R&D side of it.
Right.
So they're very, very serious about that's a lifeblood for them.
It absolutely is.
On the negative side, there's a lot of volatility here.
Right.
We know that tech in general has a higher beta than the rest of the sectors in the S&P 500. So it's not for the faint of heart.
No, again, we've talked about, so, you can pick any of these stocks from the Magnificent Seven, and there's been periods of time where they've been really tough stocks to hold. Amazon's an example that we've used in the past. I think there's something like double-digit 80% drawdowns going back to late 90s, early 2000s. I think was when Amazon had IPO'd, and if you look back to 2000, if we just say 2000 until year to date, Amazon looks like an incredible investment to have held for that time period. The average annual returns are robust and greater than the broader market has provided. However, again, you've had some serious drawdowns that you would have to live through and have the stomach watching this stock sort of go up and down. But if you've held it for the long term, it's proven to be a very good holding.
Everything looks easy in retrospect, but at the time, the psychology of holding on to some of these stocks has been very difficult.
Very difficult.
So the dividends tend to be lower here. They're not kicking out a lot of cash to their shareholders by design. They're putting it back into the research and development.
Right.
And so you're not going to want to necessarily build an income strategy around these stocks.
No question. And that's been, as you mentioned, there's a positive for taxes. If you have long-term capital appreciation but they're not kicking out dividends each year. Well, you pay taxes on those dividends if it's not held in a retirement account. So having these stocks that are growing, beyond the broader market, yet not kicking out dividends to you on an annual basis where you have to pay tax on them. Well, now you've created this like optimal tax investment where you've got
Sure.
long-term growth and a very low tax bill associated with that.
Yep. And valuations they tend to be higher.
Right.
It's the price to earnings forward on these is, I think it's up towards of 28 as an average within the S&P 500.
Yeah.
Some of them much higher than that.
Right. Yeah. It's again, it's come back to that not being for the faint of heart.
Right.
Because at some point in time, valuations matter, and when things are going sideways or maybe not going, positively in the economy, valuations can matter, and these stocks can get beat up.
All right. Good stuff. That's all we have there. So that's the end of our two fiduciaries today, and we just want to thank you for stopping by. If you have any questions, please let us know.
Absolutely. Thank you.